JP Morgan's longtime CEO Jamie Dimon today says the economy is slowing and tough times could be coming. The trade war is heating up today, with the EU that is retaliating alongside Canada, quote unquote, going to put pressure on the United States and kind of team up together. Inflation came in below expectations, and if you thought that was impressive, just wait until I show you March's expectations for CPI. The headline markets are bouncing today. The SPY is up 0.7% at the time of recording this video. From the low of this correction, you have already bounced about 1.5%. At one point, you had bounced about 2% since the low yesterday. Unfortunately, I don't think this is a buyable dip, and I will tell you why in this video. Really, the long story short, the fact of the matter is the economy is going to weaken from here. Trump wants the economy to go into a recession, to lower 10-year treasury yields, to kill inflation. And until I'm proven otherwise, this is not a buyable dip. Because if we did go into a recession, you're looking at downside that most people think is unimaginable. Like, imagine getting back to the lows of 2022. From current levels, that would be a sell-off of about 40% from here. Overall, like a 50% drawdown in markets. And I think the risk is too high of that to go out and confidently buy a 9% pullback. And there's a famous quote on Wall Street. It's rather old, but it goes something like this. The stock market will stop panicking when policymakers start panicking. Trump is not panicking. The Fed is not panicking. When they start to panic, they start to swoop in and try to save the day, is probably when markets bottom, unless the damage is too far gone and you're already in a recession at that point. And unfortunately, you kind of have a perfect storm brewing where the economy's weakening, inflation's too high for the Fed to really do much about it, and tariff uncertainties on inflation is really keeping the Fed at bay. First and foremost, JP Morgan CEO Jamie Dimon says tariffs are causing uncertainty. But Jamie Dimon goes on to say, quote, "I am seeing some weakening in the economy and negative sentiment." This is not the Jamie Dimon that you've heard in years prior. Jamie Dimon has always had positive things to say about the economy, that the economy is strong, consumers are strong. But today was the first time I can recall in years that he's actually saying the economy is weakening. I mean, that is telling. It is also being reported that hedge funds are selling stocks at a pace not seen in years. It was also reported that people withdrawing or moving around their 401ks is up 75% in the last 3 weeks, which is usually not something that people do. I would argue the reason for that is because people are nervous, they are uncertain, specifically in regards to their job security. People are nervous about their job security. They're withdrawing from their 401ks or going into more defensive areas like treasuries, because if they did lose their jobs, they need that money, to ultimately live on. And also reported today, credit card debt has hit another record high as people believing they're about to default or could default within the next 6 months hit the highest levels since April of 2020. Mix that combo together and it looks ugly. Kathy Jones on X writes, CPI and core CPI pulled slightly lower. Airfares declined, contributing to the slowdown in inflation. And you could see a slight downtick in inflation, which, recently inflation's been moving higher, and this is definitely a step in the right direction. Now, Truflation, which is updated daily, is sitting at 1.32% on a year-over-year basis. This thing is absolutely plummeted in late February and in March. A lot of it has to do with energy prices, and we are soon going to see this reflected in the BLS inflation. Typically, the rise or fall in Truflation takes about 45 days to be reflected in the BLS report. And if you look at the March 2025 estimate for CPI, you're looking at 0.01%. So essentially 0% inflation for the month of March. That's the current expectation. PCE is expected at 0.04%. Core PCE is expected at 0.22%, and core CPI is expected at 0.26%. Now, also in the news today, the EU said on Wednesday it would impose a counter tariff on 26 billion euros, about $28.33 billion worth of US goods starting in April in response to the tariffs. And Canada announced today they will impose 25% retaliatory tariffs on $21 billion worth of US goods. The new tariffs cover steel and aluminum, as well as other US goods, including computers, sports equipment, and cast iron products. And the big story today was really CPI. Core month over month came in at 0.2%. Expectations were 0.3%, so that was better than expected. Core year over year came in at 3.1% versus expectations of 3.2%, so that was good. Headline inflation came in at 0.2% versus 0.3% as was expected, so that was better than expected. Year over year headline came in at 2.8% versus the expected 2.9%. So across the board, softer than expected CPI. That's positive. But the interesting part about today is bond yields actually didn't respond the way you would expect. We had better than expected CPI, and 10-year Treasury yields went up about 1.5 basis points today. I think this is largely computer driven, and what's really happening today and what you've seen recently is bonds have been bought as stocks have fell, right? So you've seen the 60-40 portfolio working as designed, okay? Well, today you should have seen bonds go up, bond prices go up, bond yields fall. So you should have seen TLT rise. Instead, it fell today. Okay, and you should have seen stocks rise, and you did see that. So something weird is going on in the bond market, and bond investors are kind of confused, and it seems like right now bonds and stocks are just competing with each other, right? So things are not acting rationally. This also means that the probability of Fed rate cuts fell today. So with a softer than expected CPI, you would expect the odds of rate cuts to actually go up. They fell. So the odds of a May 7th cut, well, pretty much dissipated. I mean, yesterday you were sitting at almost 38% odds of a May 7th cut, and now it's at 28.9%. So you fell like 10% today with softer than expected CPI. Now, June 18th, the probabilities for a cut still intact, 57.7%, and actually moving up. So short term, the odds of a cut fell, but when you look at June, the odds of a cut went up a little bit. Just very strange given CPI came in better than expected today. Now, Trump said today, quote, the U.S. to impose reciprocal tariffs, claims EU and Ireland took advantage of U.S. tax and trade policies, vows to respond to EU counter tariffs, targets the trade deficit, says EU blocks U.S. farm products and cars, confirms auto tariffs are coming, and calls Canada, quote, one of the worst on tariffs, citing dairy disputes. And Trump said this about the EU's reciprocal tariffs, quote, we'll win that financial battle. So, suggesting that there is going to be a larger trade war with Europe. Europe really hasn't seen the trade war yet. It's been Canada, it's been Mexico, it's been China, which those are our three largest single country trading partners. But some European countries like Germany, the UK, and France are also big trading partners. So it could get noisier. Donald Trump says he is not happy with the EU. Trump said specifically the EU has gone after our companies like Apple. Trump says that he can pressure Russia but he hopes it won't be necessary. It was reported today that Russia is planning on following through with the ceasefire with their own conditions, and we don't know what those are. Trump said today there will be flexibility on tariffs, but there will be very little flexibility once we start. So I don't know what that means. Now, the incoming Canada Prime Minister Carney says that he is ready to meet with Trump and looking for a common approach. He said again, we are ready to sit down with the US government and with Trump to discuss tariffs and trade. And I do think that is really the reason for the bounce today, is some renewed optimism that tariffs could get sorted out and there could be a deal made. But again, I think Trump is really just trying to push us into a recession to lower interest rates, to kill inflation, and get back to business as usual afterwards, right? That it's tricky though. You can't really stop a recession once it starts, okay? But I think that's the idea here. And I think cutting deals in the trade war doesn't lower treasury yields. Maybe it helps, with some of the inflation concern, but it doesn't help lower bond yields directly. And that's really what the president is after. They've made it clear. And I don't see the trade war just ending anytime soon. The areas that we're attacking could change, and you should expect that. But I don't see the trade war ending anytime soon. And until there's some clarity there, until the situation is not as liquid and evolving, Wall Street's going to continue to sell the bounces, sell the rallies that we get. Now, Italy's economy minister says that tariffs announced by the US administration could hurt Italian and EU economies, with ripple effects on global trade. Now, Canada's foreign minister Jolly says Canada will work with Europe to put pressure on the Trump administration. And it's like, good luck. That's what Trump is vying for. He's trying to create this uncertainty. He's trying to create a larger trade war to slow down business investment, to again push us into a recession. That is exactly what Trump wants, from everything I can see. I mean, there's no other reason why he would be doing this other than to push us into a recession. That is the obvious outcome of all of this. And we did get some weird news from the World Trade Organization. It says European exports and imports were much weaker than expected, while Asian exports and North American imports exceeded expectations. I think this could be some of that pull forward effect from the tariffs. Everyone knew tariffs were going into effect, so they were really importing as much as they possibly could before the tariffs. And I think that's been very well represented in the data. That's part of the reason why the Atlanta Fed GDP Now tracker is tracking, negative 2.4% Q1 GDP, because we've had a lot of imports and not a lot of exports relative to imports. Also, again, consumer spending being down, retail being down, that's also a contributing factor, but it does seem like the trade is really weighing on GDP. Now, the CNN Fear and Greed Index today is sitting at 20. You are in extreme fear with all of your major categories in extreme fear, besides market volatility that's now only in fear, and junk bond demand that's in extreme greed. The percent of stocks trading above their 50-day moving average actually falling a little bit today, negative 0.65%, down to 23.6%. So you're still, again, at a very negative level. Only 23.6% of stocks are trading above their 50-day moving average. So, is there room to bounce here? Yes. But is it going to be a sustainable bounce? That's the real question. Again, the AI Investor Sentiment Survey over the past 2 weeks has been very bearish, not bullish at all. We will get a new one coming out Thursday, so coming out tomorrow, and I think that'll be important to kind of piece together the sentiment picture that investors currently have. We do also have some important earnings over the next 48 hours or so. Today in after hours, you have Adobe, UiPath, Centennial One, Crown Castle, American Eagle Outfitters, some others. Thursday pre-market, you have D-Wave and Dollar General, so tomorrow morning. And then Thursday and after hours, you have DocuSign, Ulta Beauty, and Semtech. So a lot of those consumer names, something like Adobe could be considered like an AI software. So important sectors, I would say, to watch. And here at the time of recording this video, the Dow is up 0.25%, S&P is up almost 1%, NASDAQ up 1.64%, Russell 2000 up 0.16%. Again, with CPI coming in better than expected today, you would think the Russell would be outperforming. It's not, okay? It's the underperforming index, which is kind of still a nod towards those recession fears. People are not rushing out and buying the recession sensitive, index, which is the Russell. They're continuing to be more defensive, with really Mag 7 saying a lot of the bid today. The VIX is down about 9%. You're still elevated. You're still at 24.44. But you are making progress today. And again, I think it's mostly just computer driven, and you really haven't seen the capitulation moment yet. And don't be surprised if this bounce is very short lived and fear comes back into markets. And, there is an old saying on Wall Street that Wall Street will stop panicking when policymakers start panicking. Policymakers are not panicking yet. The Fed's not panicking. Trump's not panicking. In fact, they don't give a crap what's going on with markets, right? When policymakers start to panic and start to pivot and U-turn, and the Fed starts to be dovish, or, Trump backs down from the trade war and acknowledges that the stock market has fallen too much, then that's when markets are most likely going to bottom. But markets are probably not going to bottom until policymakers quote unquote bottom or panic. So let me know what you think about this information down below in the comment section. Again, we are facing recession risk this year. It's uncertain though. We don't know, if this negative Q1 GDP print is going to hold, what next quarter is going to look like, or what's going to happen with the labor market. Like, are we actually going into recession? If we do, there's a ton of downside from here. If we avoid a recession, how strong is the economy? There's a lot of uncertainty there. What's corporate profits going to look like? Slapping tariffs on different sectors, and what's the ultimate, reciprocal tariff outlook going to look like, and how's that going to affect profitability? I don't think the bottom is in, although I've been calling for a short-term bounce for a while now. I think that's all this is. Trade that if you would like, but once we get back close to that 200-day moving average, that's the moment in which I would be looking to short the markets again, to hedge the downside. 300-day moving average around 546 is also gonna be a level you might find some support, and then ultimately you could be making your way down to that $500 level in due time. That would be a 18% pullback from all-time highs, almost 19%, and then we'll see if recession actually comes or not. But I don't think this is a market you have to FOMO back into. I don't think, we're heading straight back to new all-time highs or anywhere even close to that, if you want my honest opinion. So let me know what you guys think down below in the comments section. Have a fantastic rest of your day, and I will see you in the next one.